Hello there, welcome back. We're now going to have a look at non-current assets section of your notes. And this area of the syllabus is really important. You're always going to see one or several questions on non-current assets in your exam. Now, it's first of all important for us to define not what a non-current asset is, but what an asset is. Now, an asset, by definition, by the framework or statement of principles, defines an asset as a resource controlled by the entity as a result of past events where future economic benefits are expected to flow. Let me break that definition down. It's a resource that we control. Okay, so we control the use of that asset. Now notice we said an asset is what we own in earlier chapters, but not necessarily. It's something that we control. Now a lot of the time that will be same as the ownership, and certainly that would be the case in this syllabus. So if we're thinking about, let's say, a property, well, the property is what we control. We control the use of that asset. As a result of past events, well, the business must have entered into a contract for the sale of that property. That would be the past event. And finally then, where future economic benefits are expected to flow. Well, what we mean by that is when we are thinking about the asset, we're using that asset to generate us economic benefits. Now, that could be through using, let's say, the property as a warehouse where we store the stock or inventory that we use to then sell to our customers. The future economic benefit will be the cash inflow from selling those goods. Or maybe it's a factory and you have machinery in that factory, and that machinery we use to produce goods, and those goods we then sell, and again we earn income and obviously cash inflows as a result of that. So there has to be an economic benefit to the business from using and controlling that asset. Now, that's just an asset. That's just an asset by general definition. Now let's go further and look at what a non-current asset is. So then, a non-current asset. Well, a non-current asset is an asset that is intended for continued use in a business. So notice the word continual. We're going to continue to use that asset for several accounting periods. So remember, when we think about a non-current asset, it's a long-term asset. We're going to keep it for greater than 12 months or more than one accounting period. And then we think about the word use. We're going to use that asset within our business. So if we have a property, we're either going to occupy that property and have our admin, our HR, our accounts department in that office and use it as a head office. Or maybe we're going to use that property as a factory or a storage location. Okay? We're using that asset within our business. And as a result, by using that asset, hopefully we'll generate those economic benefits as defined before. Now, with non-current assets, because we're going to keep them for a long period of time, we have a separate section for them, if you remember, in our Statement of Financial Position, or as I abbreviate it to SFP. And that's going to come at the top. So, thinking about that non-current asset then, it's going to appear at the top of your Statement of Financial Position. And what we're going to do is carry it at its original cost, less any accumulated depreciation. And we'll see the idea of accumulated depreciation a little later on in the cost. So, here are some typical examples then of what non-current assets are. And what we're thinking about at the minute is the idea of a tangible non-current asset. It's an asset that has physical substance. You can touch it. I say it's an asset that you can kick. Now, you probably can't see that at home, but I usually boot the table at this point to illustrate that it has physical substance. It's there, you can see it, you can touch it. So, typical examples then of tangible non-current assets would include land, your buildings, We have plant and machinery, motor vehicles, computer equipment, so your computer hardware, so the screen, the monitor, the keyboard, the hard drive, etc., and then fixtures and fittings. All would be typical examples of tangible non-current assets that would be asked to account for in this section. Now, first of all, we've got to look at the initial recognition of those tangible non-current assets. How do we measure their value initially when we first record them in our books? Well, what we do is we record them at cost. And what we have to do is think about the cost of that asset for bringing it into use initially. Now, there's this distinction there between spending money on acquiring an asset and spending money on improving an asset and spending money maintaining the asset or repairing it. Now, to distinguish between the cost and the subsequent expenditure, we need to have a look at this idea of capital and revenue expenditure. So let's consider them first of all. Now, capital expenditure, to start off with, is the costs physically incurred in acquiring that non-current asset. So, if you pay $50,000 to acquire a new machine, and you physically incurred that cost to acquire that machine, well then that is known as capital expenditure. Now, this idea of capital expenditure is defined in another accounting standard. This is IAS 16. Remember, IAS stands for International Accounting Standard number 16. And this covers the whole idea of tangible non-current assets. Now, when we think about capital expenditure, yes, it's the physical cost of acquiring that non-current asset. But it's also the costs involved in bringing that asset into its present location and condition. Okay, so there can be other costs that you can capitalise and add to the acquisition cost of that machine when you initially acquire it and pop it into your financial statements. So, let's have a look then. First of all, we've got the initial cost of the asset. So, that would be the physical purchase price. Then we've got to think about getting that asset into its present location and condition. Now, if I purchase a machine, obviously the supplier who's supplying that machine will not deliver it to my warehouse or my factory for free. I'm going to incur some delivery costs on that. Well, I need to pay those delivery costs to get that machine into my warehouse. As a result, that's a cost of bringing it into its present location and condition, so the delivery costs can be added to the acquisition costs of that machine or any other non-current asset. Next thing we think about then is any non-refundable import taxes. So if you have to import that asset from another country into your country, you may have to pay some sort of import duty. If you can't reclaim that import duty from your local tax authority, well, that can be added to the cost of the asset as well. Any installation costs necessary, again, for bringing that asset into its present location and condition. So, in order to get that machine into your factory, maybe what you need to do is knock down a wall in order to get that machine into that building, because there's no doors big enough to get that machine into your factory. So, knocking down the wall, putting it in, and then obviously rebuilding the wall back up, that would be an example of an installation cost, and that would be added to the initial cost of the asset. You had to incur that expenditure in order to get that asset into its present location and condition. Finally then, we've got any other costs incurred in bringing the asset into its intended use. So, maybe to acquire, let's say, a building, you need to have an estate agent. You need to have a solicitor or a lawyer of some kind in order to exchange contracts and complete the sale. Well, those legal fees are necessary in order for you to get that asset into its present location and condition. So that would be a good example of any costs incurred in bringing that asset into use. So legal fees or estate agents' fees, they're all costs that are necessary. And you can add the cost of your solicitor to the asset that you've acquired. So the invoice, obviously, you get from your solicitor for the time that they've spent in completing that sale of that building, for example. There can be other things as well, such as initial testing. If we go back to my example of a machine, you've got the machine in your factory now. Now, before you can start using that machine to make, let's say it's a printing machine and you're printing T-shirts as a result, maybe you need to check the alignment of the machine to make sure that the print that comes off and the T-shirts that are printed, it's correctly aligned and it's all above board. That initial testing of the alignment, the costs of that, well, that can be capitalised and added to the initial cost of the asset. So that initial testing, yeah, that's fine. Now, all of these costs then gets added together as capital expenditure, and that would form the total cost of the asset upon initial recognition. As a result, then, what you will do is you will do the following double entry for it. So, with the total cost of the asset, the double entry would be to debit non-current asset cost account. Now, obviously, with non-current assets, each different type of non-current asset would have its own T account or ledger account. So if you acquired a machine, you would debit and increase the asset value of the machinery account. If you acquired a building, you would debit the building's cost account. Motor vehicles, debit the motor vehicle's cost account. So for each different type of non-current asset, it would have its own cost account, depending on obviously what type of asset you are recognising. So remember, to debit an asset, remember that's the A in dead click, increase that up, that's a debit entry. Now, depending on how you pay for that asset will depend what the credit entry is. If you took out a loan to acquire that asset, well then you would credit a loan liability. Maybe you paid for it in cash, and we'll assume that. If you paid for it in cash or from your bank account, you would credit and reduce your asset of cash at bank. But depending on how you paid for it would depend on what the credit entry is. What's important is the debit to increase non-current asset cost, with the initial cost of the asset plus any cost to get it into its present location and condition. All that capital expenditure. Now, your non-current asset cost figure would appear in your statement of financial position as the initial cost of your non-current asset. Now, when we think about capital expenditure, initial purchase price plus any cost to bring it into its present location and condition. But you can also have subsequent expenditure as well. Now, capital expenditure can also be subsequent expenditure, and if that subsequent expenditure enhances the performance of the asset or its income generating ability, well then you can capitalise that cost, but only if it enhances the original operating performance of that asset. Let me give you an example. Let's say, that I'm a builder and I acquire a motor van, okay, and I have that van so I can go around and see all my customers and, do building jobs for them. Now, that builder, obviously they've acquired that motor vehicle, they would capitalise that asset as capital expenditure. A couple of years later then, me, the builder, I think, right, I want to make this delivery van or this motor van, sorry, not delivery van. I want to make this van a lot better. What I want to do is I want to put racking in the back of my van so then I can store all my tools. Makes my job a little bit easier. Well, that expenditure to put that racking in the back of the van, I would say, would enhance that van. Okay, if I wanted to sell that to another builder in the trade, they're obviously going to look at that van and say, well, they've got tools in the back. That's very handy. I can put my own tools on that racking in the back of the van. Okay, so that cost of, putting that racking in the back of the van, I would say would be capital expenditure. And I would add the cost of putting in that racking to the original cost of the delivery van. Now, let's say then in that same year that I'm driving along in my van on my way to another customer. Oh, all of a sudden I've got a tyre and my tyre has been punctured. So I've got a flat tyre. And I sit there and I'm like, flat tyre, what am I going to do? Well, I might have to replace the tyre if it's quite bad. So maybe there's a big nail bent over in there. So I need to get my spare tyre out, which obviously has cost me money. I need to put that tyre on in order to repair that tyre and replace that tyre with a new one. So then I can drive to my customer again. Now, by having that new tyre put onto my van, does that enhance the performance of the asset? Am I going to get more income as a result of changing my tyre? Well, the likelihood is that it won't. Okay, you're just replacing a tyre. All right, a tyre is not going to generate you more income. Okay, especially on a bog standard van. Okay, it's not going to be anything special. So what I would say about that is it's not going to enhance the performance of the asset or generate me any more income as a result. So I wouldn't add the cost of that new tyre to my original cost of my delivery van. What I would do instead is treat it as what's known as revenue expenditure. Essentially what I'm going to do is write off the cost of that new tyre as an expense to my statement of comprehensive income. So, when we think about this idea of revenue expenditure is the expenditure on maintaining the earning capacity of that asset. So keeping it running. Okay, so any repairs or maintenance costs, like repairing that tyre or replacing it, that's going to maintain the capacity of that vehicle or machine or whatever it is, and therefore will not enhance the asset. As a result, we cannot capitalise the costs of repairs and maintenance. What we do is we treat them as an expense in our statement of comprehensive income. So, what is important to know is that you do not show it as an asset in the statement of financial position. You treat it as an expense. So, insurance, okay, if I have to insure my van, okay, just because it's got a bit of insurance doesn't mean it's going to enhance the value of my asset. I'm not going to get any future economic benefits from having insurance. It's just essentially a cost of running the van. And the same goes with repairs and maintenance. As a result then, any repairs or maintenance or insurance costs, they get written off to the income statement or statement of comprehensive income. The double entry would be debit and increase the expense account in the statement of comprehensive income. So, if that is a insurance expense, then you would debit the insurance expense account. If it was a repair, debit repairs. So again, for each different type of expense, you're debiting that account. And then if you're paying for that expense straight away, obviously then you would credit and reduce your asset of cash at the bank. So it's really important to be able to distinguish between capital and revenue expenditure, because capital expenditure can get added to the cost of the asset in the statement of financial position, and revenue expenditure is an expense, therefore reduces profits in your statement of comprehensive income. Learn the typical examples of capital and revenue expenditure for your exam. Thank you.